Let's get to another big story that's overhanging financial markets, and that is energy. Crude oil coming off overnight. But does the OPEC deadlock, as well as ESG concerns, impact the local energy plays? Well, let's see how Sean Fenton is thinking about that sector. He is from Sage Capital. Sean, welcome to the program. Look, there's a lot going on in energy right now. There's some concern that the OPEC Plus cartel could be breaking down. Who knows how that would ultimately impact energy? But what is front of mind when you're looking at those big names here in Australia?
Yeah, certainly a bit of volatility overnight with OPEC, but those political wranglings have been going on for decades, so they'll eventually get sorted out. We do see a strong backdrop for energy demand with the reopening, and that's been generally supportive. And ESG is a very interesting, complicating factor within that. It's certainly, I think, having an impact on the valuation of equities as investors have been cutting energy exposure with increasing ESG mandates. The other interesting impact it's had is the pressure that activist groups have had on large oil companies, and the listed majors have wound their capex plans back materially. So one thing you are seeing is a tightening supply demand outlook looking forward, with reopening, recovery of demand, but reasonably low levels of capex in the energy space for new production. You're seeing that not just in the oil market, but within LNG markets as well in the short term. So we do think it provides a few opportunities for the Australian energy companies. They do have quite a high exposure to gas as opposed to oil, which is generally seen as a transitionary fuel with lower carbon dioxide emissions per unit of energy to certainly burning coal. So certainly a need for that going forward at least the next decade or so. Yeah, and even with oil, that will take some time to transition to electric vehicles. So we do see broad appeal across a lot of the Australian energy space.
Okay, so can I narrow it down a little bit, Sean? Because you've got very few pure play oil names listed here in Australia. I mean, I can think of Karoon Energy for one. Even Oil Search is not a oil pure play oil. Yeah, it's gas, right? So we'll go figure that one. But do you look more favorably on those that have the gas exposure over those that have that pure oil play, even though we've seen that price impact in oil?
Yeah, definitely gas over oil, but probably also more producers and established producers over explorers and those leveraged into capex and development. So for Karoon, for example, it's pretty much pure oil, but they largely bought producing oil assets offshore Brazil from Petrobras. So it's a pretty mature play. So they're not spending big amounts of money to go out and find more oil and develop it. But yeah, within the Australian context, there's the larger LNG plays. So Oil Search, a little bit of political risk around PNG and developing further trains, and certainly their move into Alaska and funding that, potential sell downs probably overhanging the stock a little bit as well. But it's got a lot of gas coming out of PNG. And a lot of exposure there to LNG. Origin Energy we like as well. That's also got pretty broad exposure to LNG markets. Has a domestic energy retailing generation business as well. That's been under pressure with very weak wholesale electricity prices. Also part of the increasing role of renewables in the grid and what that's doing to electricity prices. But even accounting for that, it certainly looks pretty cheap. But certainly smaller explorers or even those leveraged into capex like Worley Parsons, who have been doing their best to get away from energy capex. Bought Jacobs Engineering, trying to get into more downstream petrochemicals and maintenance, and they're doing their best to get away from it. It's still a lot of exposure to that energy exploration development, particularly sort of deep water offshore drilling, which has been under a lot of pressure.
Mm-hmm. All right. Listen, I'll just take a hard right turn from that. I would like to get your thoughts on the RBA because obviously it's overhanging much of the conversation today, Sean, from an investment perspective. So we can talk about taper and we can talk about whether or not interest rates will change sooner than that 2024 mark. But I mean, what sectors do you think currently will continue to benefit from this ultra low interest rate environment that we're in?
Yeah, a whole range of different ones. Certainly, the RBA started its tapering, but as they always do, they'll go very softly, softly. So the world's a very different place, as it's turned out, to the fears when a lot of those policies were put in place over a year ago, and that is fueling, bubbles not just in Australia but all around the world. So the housing market's a very obvious one, but you can point to things like tech valuations and Bitcoin and gold and everything else. So easy money is going to continue to keep real yields down and drive some of those speculative areas. But broadly, the economy is doing very well as well. So, we do see broad support for a lot of the sort of cyclicals within that space. Housing is a very interesting one, certainly with that tapering and fixed rates starting to move up. And the RBA starting to talk a little bit more about macroprudential controls, maybe increasing serviceability buffers or something along those lines. We might see the heat start to come out of the housing market, but there is a big pipeline of construction work that needs to be done there. That said, building stocks have done very well, and we think they're probably as good as it gets near their peak. They're not shorts, but it could be a time to take profits. Similarly, we see the broader economy doing quite well with reopening, but probably more in the services space. More back into travel and services that are unlisted. So it'll be an interesting little period for the retailers that are doing exceptionally well profit-wise. It will probably continue to do well, but very hard to cycle some of those profits. But broadly, the economy is being supported with a lot of activity and easy money. So we see retailers one of the trickiest areas to get right. Over the little period could be more trading around ranges and opportunities there.
So if retailers are doing well, money is still cheap. We still have a lot of enthusiasm to go out and spend. I understand that Afterpay is one of your biggest holdings in the tech space. I mean, surely Afterpay continues to benefit from that thematic as well. Sean, when do you as an investor start to get tempted to take some profits in Afterpay?
Constantly. So we bought back into it when it fell back to $90, and it's had a good rebound. But you do need a broad mix of different stocks across the portfolio. So we try not to anchor ourselves too much in just growth or just value or anything like that. And within that sort of spectrum of more expensive stocks with big growth expectations, Afterpay actually is delivering. So obviously not just Australia, but the whole buy now, pay later sector. Globally, it's continuing to push into the US and take share there, and there's new market opportunities. There's always a bit of regulatory background risk in financial services and whether they're credit or not. But we see them as having leadership within that segment. Recently PayPal sort of put up prices for merchants, so the issue of competition's probably taken a little bit of a step back as well. And you do know they will continue to deliver in terms of customer numbers and activity and revenue growth and falling through to the bottom line. So whilst that momentum's strong and real yields are low and central banks are supporting liquidity, then it's a stock that will do well in that environment. But everything can get pushed too far, so there's times when you do take profits. So certainly back up near its highs of $150, $160 is certainly tempting to be taking profits there, I think.
Yeah, certainly so. All right, Sean, always a pleasure to have you join us on AusBiz. Really appreciate it.
Thank you. Thanks for having me.